Welcome to House Talk USA. Today we're breaking down how mortgages work in America clearly, simply, and in a way anyone can understand. What is a mortgage? A mortgage is a loan used to buy a home. You borrow money from a bank and repay it monthly over many years. The home acts as collateral, meaning the bank can take it back if you don't pay. Most U.S. mortgages last 15 or 30 years. How a mortgage payment works. Your monthly payment includes for parts 1. Principal, the actual loan amount. 2. Interest, the bank's fee for lending money. 3. Property taxes. 4. Home insurance. This is often called PITI. Some homes also include HOA fees, depending on the community. Why credit score matters. Your credit score determines your interest rate. A score above 700 usually gets better rates. Lower scores can still qualify, but the monthly cost will be higher. Down payment basics. A down payment is the money you pay up front. Common options include 3%, 5%, 10%, or 20%. A 20% down payment helps you avoid PMI, private mortgage insurance. PMI protects the lender, not you, and adds an extra monthly fee. Popular mortgage types in the U.S. 1. Conventional loan, most common. Requires good credit and stable income. Best long-term rates. 2. FHA loan. Designed for beginners. Lower credit scores allowed. Down payment as low as 3.5%. 3. VA loan, for U.S. military members and veterans. No down payment and low interest. 4. USDA loan, for rural and some suburban areas. Zero down payment if you meet income rules. Each loan type has different requirements, but all follow a similar approval process. Fixed versus adjustable rates. A fixed-rate mortgage keeps the same interest rate for the entire loan. Your payment stays predictable. An ARM, or adjustable rate mortgage, starts low but can increase later. Fixed is safer for most first-time buyers. How the approval process works. 1. Pre-approval. Before house shopping, the bank reviews your income, credit, and debt. They give you a pre-approval letter showing how much you can borrow. 2. Underwriting. After you make an offer on a home, the lender verifies everything: income, job history, bank statements, taxes, and credit. 3. Appraisal. The lender orders an appraisal to confirm the home's value. They will not loan more money than the property is worth. 4. Closing. You sign final documents, pay closing costs, and receive the keys. Your mortgage officially begins. What influences your interest rate? Credit score, down payment amount, loan type. Current U.S. market rates, debt-to-income ratio. Small changes in interest rates can save or cost thousands over the life of the loan. Mortgages may look complicated, but at their core they follow a simple system. Borrow, repay monthly, maintain good credit, and choose the right loan for your financial situation. With the right knowledge, any beginner can navigate the U.S. mortgage process confidently. Thanks for watching House Talk USA. Subscribe for more real estate guides made easy.